Dividend stocks are about to get much more attractive. Jerome Powell, the U.S. Fed chair, has announced that rate cuts are coming.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
These cuts could have significant implications for the economy and all of our investment portfolios, especially dividend-focused investors. When the Federal Reserve cuts rates, one of the immediate impacts is on the so-called risk-free rate of return, which is typically associated with treasury bills and other government-backed securities. This risk-free rate serves as a benchmark that all other investments are measured against. Warren Buffett has referred to interest rates as gravity when valuing investments. Right now, you can get just over a 5% annual yield on U.S. Treasury bills. That is a reliable income with no risk of your capital going down. This is the highest rate available in recent decades. It's finally become an attractive investment option again. Therefore, massive amounts of money have been flowing towards this option. You even see Warren Buffett, the greatest investor of all time, heavy in cash, with $234.6 billion in T-bills. That is more than even the Federal Reserve. So it's clearly become an attractive option, sucking up investing capital. However, with rate cuts over the coming year, that risk-free rate of return will be driven down. It will become a less and less attractive investment option relative to investing in risk assets like stocks. Before the late 2022 rate increases, especially during the low interest rate environment of the 2010s and early 2020s, equity investments enjoyed substantial inflows of cash. Treasury bills were not attractive at this time. The Fed's accommodative monetary policy forced investors to look towards risk assets like stocks in order to get returns. So if you're focused on income, investors will likely flock towards dividend stocks in order to get yield. This trend will take time to play out as we don't know how fast the rate cuts will be and by how much. However, its impact is already starting to be seen in the market. In fact, this is already happening to many of the stocks I own. For example, my top high yield stock, the Altria Group, ticker symbol MO, has gone up nearly 10% this month. That is a company which still yields over 7.5%, and I was buying it at nearly a 10% dividend yield on cost. That was just earlier this year. The best part about these dividend growth stocks is that they increase their dividend payments over time. For example, Altria just had a 4% dividend increase. That increases that yield even further. And when you follow a dividend investing strategy, you can create a portfolio where your dividend income is reliably growing year after year after year, regardless of what's going on with federal interest rates. The yield on your treasury bills can be cut, but by picking the right dividend stocks, you can continually grow your yield on cost. And yes, there's risks of dividend payments being cut, but that's why I built all these investment tools so you can identify companies where the dividend is safe, and so it's set up to grow well into the future. In today's video, I'm going to share an updated look at my long-term dividend growth stock portfolio. That will include my top stocks, dividend income, and new buys. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Sign up for my free email newsletter if you want help finding better dividend stocks. Here you can see my long-term dividend growth stock portfolio. In it, I have 13 total stocks with it highly concentrated among my top holdings. The total value is $187.3 thousand with $122.2 thousand invested, giving me a total return of 53.18% or about $65,000. My top holding is Visa, ticker symbol V. This is currently valued at $42.9 thousand and I have a 9.38% total return. And if you're wondering, this has been my biggest buy in 2024. This is a lower yield company but has reliable high growth and a fantastic, scalable, high margin business model. They repurchase shares at a high rate and have very fast dividend growth. The 10-year compound annual growth rate of Visa's dividend is 17.92%. The payout ratio is very low at 20%, so there is plenty of room for continued growth over time, especially when you consider consider their actual business is growing at a high rate every single year. Next, I have Microsoft, which is also a dividend growth oriented company. The current total value is $42.4 thousand with a 74.3% total return. Fantastic business, fast growing earnings, reliable subscription revenue. The dividend grows at 10% like clockwork at a very sustainable payout ratio. Microsoft and Visa act as core pillars of my portfolio focused around long-term dividend growth. I'm young and not currently focused on living off of my dividend income right away, so I have my portfolio currently focused towards total return over the long term. However, that does not mean I don't own high yield stocks. For example, I have the Altria Group, ticker symbol MO. That is currently valued at $28.8 thousand, and I now have a 45% total return. And this is my largest dividend payer by far, and it's projected to pay me $2.2 thousand a year. And that income is consistently going up because of two factors: dividend growth and dividend reinvestment. For example, in July, I was paid $515.75 from the Altria Group. I reinvested that to earn 10.9 additional shares in the company. And as I mentioned earlier, they just grew their dividend another 4%. So my next dividend payment for the Altria Group is going to be $548. That's a big jump from $515 in the prior quarter. And this is just one example of the dividend snowball effect at work. Those $550 will allow me to buy even more shares, increasing my future dividend income. And it's at times like these where I am very happy I was buying the dip on the Altria Group stock for a long time. My fourth stock is ExxonMobil, ticker symbol XOM. The current total value is $19.4 thousand with a 244.58% total return. And this is my second largest dividend payer at $626 of projected annual income. And from reinvesting dividends since my purchase in 2020, I now have an 11.10% dividend yield on cost. Oil is a very cyclical business depending on the price of oil at any time. And I bought it at the perfect time during a massive crash, and I'm just planning to hold and reinvest my dividends. And Exxon and Chevron are unique oil companies in that they continually raise their dividend payments on an annual basis, even through bear markets in the oil business. And the reason for this is they manage their balance sheet in a manner that they can continue to provide reliable income even when they're going through a bad year. And in years like 2022, they had massive profits, and they're still highly profitable right now. However, they have kept their payout ratio based on free cash flow never going above 45% and as low as 25% in 2022. They're not doing massive special dividends or increasing at an unsustainable rate. They have been very responsible during this oil boom market. Other stocks include the Walt Disney Company, which is my worst performing investment and was one of my bad buys. However, I think it's a good buy right now, which is why I'm still holding on to it. I'll talk more about that in a little bit. And then I have Apple, ticker symbol AAPL. That's an 88% total return. And over the long term, I'd love to have this be a core position just because of how high quality of a company it is. That said, I do think there are much more attractive opportunities in today's market. Following that, I have T. Rowe Price, Kroger, Enterprise Product Partners, PepsiCo, Chevron, Automatic Data Processing, and one of my newer additions, Starbucks. All of these companies, though, regularly increase their dividend payments on an annual basis. Comment below if you want to see an updated stock analysis video on any of these companies. This portfolio generates $4,821 in annual dividend income. That's $1.2 thousand every quarter, $401 every month, $13.21 every day, and 55 cents every hour. We just had August, which is my lowest paying month in the cycle, since almost all my stocks have a quarterly payment. September and October are going to be big though. Since I started this account, I've earned $13.8 thousand in dividends. That was $3,500 last year, and so far in 2024, I've earned $2.8 thousand. And in July, I just had my largest month of dividend income ever at $586.79. And over the long term, I'm just on a continued path to steady dividend growth. And this is while achieving a solid total return as well. Since I started actively managing my account, I've actually been slightly beating the S&P 500. So that's the current status of my portfolio, and it's been pretty boring since my last update. And I actually have not bought very much at all as the market has gone up in that time. I nibbled and bought 2 more shares at a cost per share of $86.57. And the reason for that is I actually think it's a really good buy right now. So much so that I ranked it as my top stock pick for August 2024. And if you sign up for dividenddata.com, then you can read my entire investment thesis on the stock. And again, every month you'll get my best stock pick plus additional research I publish. And again, for existing dividenddata.com members, this is available at no additional cost. More value added into the service. And if you're new and do sign up, you can also view my stock watch list and dividend portfolio live that will automatically update as I make changes. And you can use my stock screener with all the information you need to make better investment investing decisions. And this past month, I put out a great update, which includes future earnings estimates for earnings per share, letting you see what the potential PE ratio would be in future years based on today's price. I also added analyst price targets that show you the low, the high, and the consensus on Wall Street. This lets you see when a stock is overvalued or undervalued based on those targets. For example, Disney is 51% undervalued based on Wall Street price targets. You can also see analyst buy ratings, which Disney is currently rated 79.3% a buy. And I'm constantly going to be working to add more and more value into the service. Thank you for watching this month's portfolio update video. And if you found it valuable, please leave a like, comment, and subscribe to the channel. And if you just want a great source of information helping you find better investments, then please sign up for our free email newsletter. Link in the description. Thanks for watching.